Do you want to become an amazing investor? Warren Buffett, one of the world's richest people, practices certain principles that made him what he is today. If you can grasp these principles, then it can help you solidify your fundamentals when it comes to investments. In this video, you will learn what Warren Buffett has to say when it comes to investing. This is a must-watch, especially for those who are new to the investing world or those who do not know how to invest. Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the essential details that can help you keep yourself up to date about finances, wealth, and investments, then make sure to watch until the very end. Number 1. Invest based on data, not feelings. When you're getting started in the world of investing, you need to be able to manage yourself toward making the right decisions. While this may sound easy on paper, most people find it difficult to put into practice as they often let their emotions drive their investment decisions. When the price goes down, people tend to sell and lose lots of money. They get further riled up by the news they see on the internet, which made their emotions run even more out of control, and then they purchase more stocks that will then tank the next day. To this, Warren Buffett has some advice for you. Quote unquote, investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and say, I made money last year. I'm going to make more money this year. So, they're always looking in the rear view mirror. And when they look in the rear view mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rear view mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that's what makes for huge opportunity. Looking at what he said, Warren Buffett basically told people that those who sell because they didn't earn money the past year allow an amazing investor to enter. Number 2. Acquire great companies rather than cigar butts. Although acquiring lots of cheap companies can make you earn money, it's not as big compared to buying great companies. Warren Buffett has something to say about these cigar butts, as he called them quote unquote. I've been taught by Ben Graham to buy things on a quantitative basis and look around for things that are cheap. They made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigarette butts and you find this terrible, soggy, ugly looking cigar one puff left in it, but you pick it up and you get your one puff. Disgusting. You throw it away, but it's free. I mean, it's cheap, and then you look around for another soggy one puff cigarette. Well, that's what I did for years. Number 3. Seize the opportunity you find when it presents itself. When opportunities come, Warren Buffett has something to say about it. Quote unquote, there are big opportunities in life that has to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just a big mistake, almost like not doing it at all. I mean, you've really got to grab them when they come because you're not going to get 500 great opportunities. This means that when you encounter an opportunity, you don't dip your toes and just put in a small value. You have to grab them as they come because opportunities are very rare. Number 4. Start buying below intrinsic value. Buying an asset below its intrinsic value can be a good investment strategy because it means that the asset is being undervalued by the market. If the intrinsic value of the asset is higher than its market value, it may be considered undervalued and therefore a good opportunity to buy. This is because the market price may not fully reflect all of the positive characteristics or potential of the asset, and therefore, it is likely to appreciate over time. Additionally, buying below intrinsic value can also provide a margin of safety, which can protect an investor from potential losses if the asset's value does not perform as expected. To this, Warren Buffett said, quote unquote, "Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that the business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of businesses is." In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. It's a question of how much cash it's going to give you. That's your only reason. It's true if you're buying a farm. It's true if you're buying an apartment, a house, any financial asset. You're laying out cash now to get more cash back later on. Number 5. Financial managers need to be genuine and talented. If you're looking to hire people to manage your investments, Warren Buffett said, quote unquote, "We look for 3 things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity." Therefore, if you want to make your investments more effective, according to Buffett, make sure to hire people who have these 3 key characteristics. Just look at Berkshire Hathaway right now and all its success. It's not just Warren who's doing all the work after all. Number 6. Select stocks that you are familiar with. Investments aren't chosen just because of luck, gut feelings, and hype. You must also be sure that you will get returns by understanding how company economics work. To this, Warren Buffett said, quote unquote, "I have an old-fashioned belief that I can only expect to make money on things that I understand. And when I say understand, I don't mean to understand what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business." Number 7. Sell only if the company undergoes a profound transformation. One of Warren Buffett's principles includes not selling unless the company did something that discouraged him. He said, quote unquote, "Our inclination is not to sell things unless we get really discouraged, perhaps with the management, or we think the economic characteristics of the business change in a big way." Well, that is all for this video. As always, we in EM3 wish you the best of luck. We hope that you enjoyed watching this video, and don't forget to give a thumbs up if you liked it. Please subscribe if you haven't done so, especially if you're looking for tips, ideas, and other related information that can help you achieve financial freedom, stability, and independence. Thank you for watching, and see you in the next video.